At some point, homes stopped being places to live and became financial assets. In Part 1, we explored how policy, finance, and culture transformed the American dream of homeownership into a high-stakes investment game that most ordinary people were never designed to win. Today, in Part 2, we go deeper. We ask the uncomfortable question at the heart of the crisis: who really owns America? Not the families who live in its neighborhoods, but the institutions, funds, and global capital flows that increasingly control its housing stock. This is the story of a quiet shift in power, from Main Street to Wall Street, from families to balance sheets, and its lasting consequences for the future of the nation. The post-war promise: building a nation of homeowners. Following the Great Depression and World War II, America confronted a massive housing crisis. Millions of veterans returned home to a severe shortage, estimated between 2.5 to 3 million units. Policymakers responded with bold, unprecedented action. The GI Bill provided low-interest, often zero down payment mortgages to returning soldiers. The Federal Housing Administration and Veterans Administration standardized long-term fixed-rate loans that made monthly payments predictable and affordable. Suburban developments like Levittown sprang up across the country. Home ownership rates climbed dramatically, from roughly 44% in 1940 to nearly 62% by 1960. For generations, this system delivered results. Owning a home meant building equity over time, passing wealth to children, and anchoring families in stable communities. It was more than shelter. It was a foundation for the middle class and a symbol of the American social contract. Yet even in this golden era, subtle shifts were underway. Financial innovations began treating housing as collateral for larger economic strategies. By the late 20th century, the line between home and investment started to blur. The stage was set for a more aggressive transformation. Let's recap the chapter. Post-World War II policies drove homeownership surge. Homes served as family stabilizers and wealth builders. Early financialization quietly took root. The financialization era, from shelter to asset class. As the 20th century progressed, housing became deeply intertwined with global finance. Deregulation in banking and mortgage markets accelerated this trend. The securitization of mortgages turned home loans into tradable securities sold to investors worldwide. What began as a tool for broadening access evolved into a sophisticated profit engine. The turning point arrived with the 2007 to 2009 global financial crisis. Millions of families lost their homes through foreclosure. Entire neighborhoods stood vacant. While ordinary Americans suffered, institutional investors recognized a historic buying opportunity. Large private equity firms, hedge funds, and real estate investment trusts moved in with enormous capital reserves. Companies such as Blackstone, through entities like Invitation Homes, purchased thousands of single-family homes in bulk, particularly in Sunbelt cities devastated by the crash. These investors operated at a scale impossible for individual buyers. They had access to low-cost capital, advanced data analytics for rental pricing, and the financial strength to hold properties through market fluctuations. Rental income streams were packaged into new securities, allowing pension funds, sovereign wealth funds, and institutional portfolios to own slices of American housing without ever managing a single property. When Wall Street buys what Main Street loses, who truly benefits? Recap. Crisis created distressed asset fire sale. Institutional buy-to-rent model scaled rapidly. Homes transformed into securitized financial products. Mapping the modern owners, institutional power today. So who exactly holds the deeds today? The landscape is complex. Large institutional investors, those controlling 100 or more single-family homes, collectively own between 450,000 and 600,000 properties nationwide. While this represents only 2 to 4% of the total single-family rental market, their presence is heavily concentrated in specific metropolitan areas and price segments, particularly starter homes. Beyond the giants, a broader investor class is active. In recent years, investors of all sizes have purchased roughly 1 in 4 homes sold in many markets. Small and mid-sized landlords still dominate overall numbers, but corporate and institutional capital sets the pace in high-demand regions. Multifamily apartment buildings show even greater concentration, with private equity firms controlling significant shares of the national rental apartment stock. Major asset managers like BlackRock and Vanguard often appear in public debate, yet their role is primarily indirect. They hold shares in real estate companies and REITs through passive index funds rather than direct ownership of vast single-family portfolios. Foreign capital also plays a notable part, with investors from Canada, China, and Europe purchasing luxury and investment properties in gateway cities. This web of ownership reveals a system where scale, capital access, and financial engineering increasingly determine outcomes. Current chapter. Summary. Hidden forces and policy failures. The rise of institutional ownership did not occur in isolation. Decades of restrictive zoning laws, slow permitting processes, and local NIMBY resistance have artificially constrained housing supply in many high-demand areas. Tax policies favoring investment properties, including generous capital gains treatments and depreciation rules, further tilt incentives toward treating homes as assets rather than primary residences. Post-pandemic dynamics amplified these pressures. Record low interest rates followed by sharp inflation and rate hikes created volatility that favored well-capitalized players. Meanwhile, younger generations face historically high price-to-income ratios, student debt burdens, and wage growth that has not kept pace with housing costs. First-time buyers, particularly from minority communities, encounter additional barriers when competing against cash-rich institutional bidders. The result is a feedback loop. Limited supply drives prices higher, which attracts more investor capital, which further reduces inventory available for owner-occupants. Consequences and the human cost. The consequences extend beyond statistics. Concentrated institutional ownership has been linked in various studies to accelerated price appreciation in targeted neighborhoods, reduced inventory for families, and in some cases, higher eviction rates compared to smaller landlords. While investors have stabilized certain markets by renovating distressed properties, the broader effect has been to widen the wealth gap and delay household formation among millennials and Generation Z. Communities change when homes are managed primarily for quarterly returns rather than long-term residency. Social cohesion weakens. The intergenerational transfer of wealth through home equity, once a cornerstone of middle-class stability, becomes harder to achieve. Final thought. Homes were never meant to function solely as commodities traded on global markets. They are the bedrock of families, neighborhoods, and democratic stability. The financialization of American housing reflects larger trends in our economy, but it is not an irreversible destiny. Restoring balance will require increasing housing supply, reforming policies to favor owner-occupants, and ensuring that investment capital builds new homes rather than merely bidding up existing ones. If this examination of the housing game has challenged your perspective, hit like, subscribe, and share this video. Tell us in the comments, what part of this system concerns you most? In Part 3, we will examine realistic paths toward reclaiming the American dream of home ownership. Understanding the forces at work is the essential first step toward changing them.